we're looking, I want to talk briefly about, and it will be brief, about, retirement investing and some of the changes that have happened in that in the last year or two. As a starting point, if you can get it going, you're a genius. As a starting point, I think it's worthwhile going back that the superannuation system up until now has been very much built around the accumulation phase. There's been all these people putting money in, and what do you get when you retire? Well, we've had things called allocated pensions or account-based pensions. I'm not sure whether I should levitate. I can't do any better than that last joke. But the problem with the account-based pensions, which were really an extension of superannuation with significant tax benefits in it, is that of course you can run out of money because all of the investment risk goes to you, the investor. And what we've found, and there's some material in your material there's a booklet on retirement planning, and there are some charts and so on towards the back of that which are quite revealing, because what has been found is that when you retire, historically, has had a lot to do with how well you retire. For example, people retiring in the early 80s before the stock market and fixed interest markets, remember, early 80s, government bond rates were 12-14%, and they started coming down and down and down, which picks the capital value up and up and up. So anybody who's invested in fixed interest there had a fantastic run. The share market, of course, followed, and starting in the early 80s, right, breezing through the 87 crash and everything else, it just had a fantastic run. And somebody retiring then, investing their money in an allocated pension, taking their income out, they'd find that they were living very comfortably, and the capital value in their account was just going up and up and up. They couldn't spend fast enough to keep up with it. And of course their kids were loving this as well. Then of course, along comes the GFC and the reverse happens. Markets drop quickly, and then all of a sudden you've got to start. I think I'll keep going without it. It only confused me now like that. If markets drop and you're having to sell assets at reduced prices to fund your lifestyle, then your capital drops like a stone. And that's the downside of the investors wearing the investment risk. The upside is when things are going well, you do well out of it. When things are going bad, you do real bad out of it. The last couple of years, and particularly all the baby boomers starting to move into retirement, institutions have spotted this coming wave of retirees and have started to come out with some, I think, semi-decent retirement income products that will provide you with some certainty of income. The good, boring, old-fashioned annuity. And if you're in the people who retire in the UK, there's been a very active annuities market there for decades. In America to a lesser extent. In Australia, there used to be a bit of an annuities market back in the 80s. It just about died, and now it's sort of coming back to life again. But an annuity, you pay your lump sum of money to an insurance company, and they will pay you a guaranteed income for a guaranteed period of time. And if it's a life annuity, they will pay you for life. The investment risk is shifted from you to the insurance company. And if it's a life annuity, it's got to be issued by a life insurance company. You can also have it indexed, and that is very, very important, because I think that, with the amount of money that's being thrown around by central banks and so on, inflation is lurking out there somewhere. The American will say there's no inflation here, no inflation in Europe. There may not be, but there's a lot of inflation in the emerging markets. India, it's an issue. China, it's an issue. Indonesia, it's an issue. And it's a bubbling issue in Australia. Just read Reserve Bank minutes every month and you see how focused they are on it. So, but if inflation gets back, if inflation rises at 7%, then your cost of living doubles in 10 years. And, over a number of years of retirement, it can eat in significantly. So in a sense, I guess it's the old saying, what's old is new again. There were index life annuities around in the early 80s, not many, but it was possible to get them. They're now back on the market again. The return that you get on your money is not great, but if inflation kicks up in the future, it's going to start looking a heck of a lot better. So I think that really, what retirement planning is about now is first and foremost it's about income, which really, is no big deal. It should always have been about that, but often we sort of overlook the obvious. It's income that gives you your lifestyle. During your working life, it was income that gave you your lifestyle, paid off the mortgage, educated the kids, saved money for when for later on in life, and so on and so forth. So let's, when we're planning, focus on building an income. And I look at it as sort of building it layer upon layer. The bottom layer, is probably a bit of age pension, and for a married home-owning couple these days, you can have just under $1 million of assets, which doesn't include your home, and still get a part age pension, plus the health card and so on that goes with it. So that's a good starting point. The second layer, I think, is probably some sort of guaranteed income, an annuity, or there are some other variations of that on the market as well, which also provide you a guaranteed income and a little bit more flexibility. Incidentally, while I'm talking about annuities, the new ones coming out too also provide you with some access to capital in the early years, and also overcome the big objection that people used to have in my early days in the business about buying lifetime annuities, which was if you got run over by a bus 6 months after taking out the annuity, all your capital disappeared into some black hole. That's no longer the case. So you've got the age pension, possibly then an annuity to probably build in security of your basic living expenses to make sure that they're always covered. Probably then an account-based pension or an allocated pension, as we used to call them, same thing. More flexible, greater investment options. You can draw on your capital if you need it, and so on and so forth. And then finally, the whole world doesn't belong to the superannuation system. Other investments that you might have accumulated over years outside that, real estate investments, share portfolios and so on. And with that, I think that income really is the key to basically your own security. It's also, I think, the key to estate planning, because if you do want to leave something to the kids, then one of the best ways to ensure that is to make sure that you're looked after on the way through, and that you don't have to start selling your assets to fund your retirement in the final years, or even worse still, have to rely on the kids to look after you, and I've seen that happen a few times as well. The other point that I would make, and this sort of relates to, in times like this, there's a lot of silly stuff going around. And when I was driving to work on Friday, I think it was, I was listening to the ABC, and it was the time when the markets were going up and down like crazy, and some bloke rang and said, I'm taking all my money out of superannuation, I can do better than these guys, blah, blah, blah. My advisor doesn't want me to, he reckons Obama's going to save the world, it'll be okay, but I'm not listening to them, etc. I can understand that person's frustration, and I can understand his misunderstanding, because there is so much misinformation out there about what superannuation is. From little things, big things, grow and all that sort of thing, that make superannuation masquerade as if it's an investment. Superannuation, I put it to you, is not an investment. Superannuation is a tax vehicle within which you own investments. Now, for example, if you own BHP shares, those poor BHP shares have no idea whether they're owned inside a super fund or owned by you and your personally. They will perform exactly the same. The difference is that at the end of the day is a different tax treatment that the capital growth and the dividends in those shares get. And for most people, in most situations, holding them in superannuation or pension fund is the better way to go. So The other thing that I would say, if that gentleman on the phone and ringing up and said, I'm sick of this share market, I can't stand this volatility, my nerves are shot, I'm switching all my superannuation into cash, that I think is a sensible, logical and understandable thing to be doing. And I would suggest that anybody who's in a super fund or a pension fund that doesn't have, flexibility about investments and the ability to move them reasonably quickly should look at getting into such a fund. Often it's these things too are not driven so much, I think, by investment considerations, but just a bit of peace of mind. Particularly when you're retired, your ability to sort of accumulate additional capital is gone. You just don't want the stress and the strain of some of the volatility that's been around the place. And the other thing that this guy said about his advisor and so on, I can just imagine this guy's advisor was probably linked to a large dealer group which was probably part of a bank or an insurance company who pushed down through their channels to their advisors, self-serving lines to really keep all the money as it is and to peddle advice which is more in the interests of the product provider than in the interests of the particular client. I'm certainly not speaking on behalf of all advisors, but there are a lot out there in that situation. And I think that one of the things, and I'm sort of coming to a close at this stage, I'm not sure how I'd go with the no slides test, pass it or fail it, but anyway. What I've tried to do tonight, and I'm very determined to bring to our clients, people who tell it like it is, and get away from sort of spin and half truths and so on, which are all about the place. And hopefully we've succeeded in doing that tonight. And hopefully that if you found the evening to be worthwhile and so on, then please tell your friends. If you found it not to be worthwhile, then please don't tell anybody. But at this stage, I'd just like to, extend a thank you to Jonathan Payne. Jonathan's a very busy individual, very much in demand, and I'm sure that you can understand, having heard him tonight, why that is the case, and we're very fortunate to have him tonight, and thank you very much, Jonathan, for making the trip over. He's just over here. He's coming and speaking at the Perth Rotary function tomorrow lunchtime, and then he's off back to Sydney. Tim, thank you. I love the sort of the common sense and the basic message that gets rid of an awful lot of the noise and rubbish that goes about investing in the share market and gets down to what are the business in. Toby for his expose and explanation of the interest market and how it goes there. I thought that was fantastic, and it's something which I think is not sort of widely enough understood. If you'd be good enough, you can't leave without doing some work. There is a quick survey in your kits there. If you'd like to just put ticks in the top scoring places there, that would be great. And there is also in your kits there a couple of booklets, one on retirement planning. So if you slept through everything I said, then you can get a better account of it there anyway. And there's also a paper there on the GFC, which I think I wrote a couple of months ago. Look, thanks all for coming out. I hope you found the night worthwhile. As I said, there's tea and coffee and so on being served outside, or one or the other or both. So please feel free to join us, and I think the speakers are all going to be here if you'd like to chat to them about anything. So thanks very much.